GetCrack. Wake up, motherfucker.
Hey, what's up? It's July 27th. All right, so I didn't get to do two streams on Saturday, so I'm going to do two streams today. All right, so we're going to go and quickly go over this stuff. So I'm going to go over the boomer portfolio. That's what I want to get to. So we're going to look back at what I picked out 6 months ago, around late January, I think, is when I started compiling a list, right? So it's been 6 months. Let's see what happens when you just buy and hold all those six stocks without doing any kind of thinking. I just picked them. They had good physiognomy, all this stuff with the charts, relative performance, very nice. And let's say you just bought and held. You didn't trade it. You ignored all the news, okay? Just blind. Just don't freak out about anything that happened between late January until now, right? We've had a lot of stuff happen over the past several months already. And so, what do you think? If you bought and held those stocks, didn't look at the news, just put your thumbs in your ears, whatever it takes, close your eyes, don't pay attention to the noise. And what happens if you just held those stocks that I picked? What would happen, right? No thinking allowed. No thinking. Just looking at charts, looking at how good the charts are, look at the relative performance, look at the absolute performance. Very little to no fundamental thinking. That means don't look at like what you think the earnings will be. Don't look at the balance sheets. Don't look at the whatever, right? No stories. No stories. Don't look at like, this is an AI stock. This is a uh, oil stock. No, none of that. This was all done before any of the noise came through. Okay, very little. I just picked the most boring of stocks that I thought, even if it was volatile, still probably would make you some money within like 3 to 6 months, right? Now, if you want to hold it for a year, that's a different story. The way the volatility is right now in the stock market, this is the reason I started trading, was that once Donald Trump came around, the stock market is too crazy. All right. Even the most boring of stocks probably get juiced up. Like you already seen already with like Dell, Intel. It's like you think they're boring stocks. No, they're not boring. They're all like meme stocks. Anything could be a meme stock in behavior. So let's see what's up with that. Okay, so that's what we're gonna start with today, and then we'll get to the markets afterwards. So, all right, let's get some background music. Let's go. Ah, dee-da-dee-da-dee-da-dee-da-dee-da. Okay, we'll get to this later. These earnings that will come out eventually. Okay, this is the boomer stuff. So I set it to 6 months. All right, let's see. Let's see if you just bought all of these stocks. You didn't even like think about which ones you should buy more of. Just buy all of them. Buy all of them. Equal number of dollar amount. Let's put it that way, right? And I had a whole selection here for you. I had Air, I had MPC Marathon Petroleum Group, Phillips 66, ESOA. Look at that. Even in late January, I picked out the best performing oil stocks, gas stocks already. I picked out for you Marathon and Phillips 66. These are the best performing oil and gas stocks. Why did I pick them? Did I know there was going to be a war? Did I know the crack spread was going to be higher? No, I didn't know a damn thing. All I looked at was the charts. That's it. Because in my opinion, the people that already know what's about to happen or what will happen many years or many months ahead of time will show up in the charts. Like if you look at the signs already telling you that what's up with this? Why is this stock acting this way at the beginning of the year? So I think all you need to do is 6 months. So we talked about the fact that the VIX is very quiet in winter and summer. So between winter and summer, you should be able to pick out ahead of time the stocks that will be winners in those 6-month intervals. And then now we're at the summer point, we should flip them out and change them to another set of stocks for the next 6 months. And you keep doing this 6 months at a time. I think that's the minimum required to do any type of trading. All you need to do is about 6 months. If you want to, we can start like switching stocks out every quarter, every 3 months basically, or maybe even like every month we could like do adjustments here or there. But for the most part, the baseline is I think you can pick good stocks every 6 months. That's all you need, bare minimum. Okay, now if you want to do a whole year, okay, that's tougher, right? You have to have more forecasting abilities. You got to really plan it out to say, well, can these stocks that I pick last a year? Now that's more long-term thinking, right? That's more long-term thinking, and that's gonna be nowadays. I don't know if you can do that with Trump in office, and even if Trump's out of office in 2 years, it doesn't matter. I think the market is completely shifted to a gambling mode. Okay, with the whole suite of options, leverage ETFs, insane narratives being pushed by the news media now. I think it's very hard to just buy and hold stock picking style. Like if you wanted to buy and hold, you got to be like me and just buy and hold NASDAQ 100 or S&P 500. Like that's it. If you want to do a little bit better than that, you have to do stock picking. Can you pick stocks that will outperform over a period of a year without actually messing around with the internals? Like, no, I don't think so. I think that's even harder. You're better off just buy and hold like the dips on S&P and the NASDAQ 100. Let the NASDAQ 100 and S&P 500 people pick and choose the best 500, 100 stocks of the U.S. world markets. That's it. You just cannot beat that, honestly. So if you want to beat it, though, you have to do some proactive measures. So one proactive measure I told you is like the 6-month period. I think that's something you have to be aware of. It's quiet in winter, quiet in summer. That's the time when you rotate out certain stocks to outperform in the next 6 months. And each time you got to do this. Now we're in the summer. We're going to have to plan out how to like, are these the stocks that will continue performing in the next 6 months? Or do you just start cutting them off? That's the problem. Okay. All right. Let's see here. Okay. Air, ESOA. This one is like a pipeline, natural gas, very volatile. VRT. Yeah, still, I don't know. I mean, I was asked the question about like, should you buy more of this or if you didn't get in, should you buy it? Because we got in like late January. It already popped on earnings. And then it popped again on April's move up. So that's a problem there. Nucor Steel. I think it's gonna have earnings today, right? Yeah, it's gonna have earnings today. Let's see how that goes. Steel Dynamics, another steel one. This one's gonna be. It's already reported. I think last week. Yeah, so it's fine. GEV reported last week. It was not fine. So GEV kind of looks like it's getting hit. Still you're up 40%, but now you're like, well, we know what earnings is. Should I hold it? Should I buy more? Should I get out, switch it out with something else? That's the question you start asking, right? So as we get through earnings of these stocks, then you have to decide, which of these looks like they're about to be losers in the next 6 months, and then just take them out and replace them with something else. That's what you're going to be doing. And JB Hunt Transport looks good. Trucking looks fine. Caterpillar. Okay, Caterpillar, we got earnings. So far, it hit $1,000. It's pulling back. I don't know. It could be a loser. This could be a loser. Arthur Daniels Midland. So agriculture. I picked one agriculture. So it benefited a lot from like the what was that? Potash and fertilizer, nitrate, all that stuff from the Ukraine war, and then again with the war in Iran. Now we're going to have a hard time getting natural gas, so that's going to increase the cost of fertilizer. So far this one's good, and it's not only fertilizer though. this is why I picked this stock, because it has a broad suite of products for the agricultural market. So they transport crops, they offer transportation of crops, they offer other things I don't remember now, but it's a good staple stock. It's great for being a boomer, and look at that. It's done well. Up 23%. You can't beat that. Okay, Corteva. I have no idea why I picked this one. It's specialty chemicals. I guess it had something to do with the war. It was being pushed up. It fell back with oil and gas, but now it's recovered. It's doing better than the other oil and gas stocks, because I don't know. It has to do something with that. I don't remember. Like I said, I just look at the charts. I don't know exactly what all these guys' businesses look like in the fundamental level. I don't got time for it. Chevron, obviously, that's a no-brainer. Of course, I would pick Chevron and Exxon. Those are the big boys, even though they're not as well performing as like Phillips and Phillips 66 and MPC Marathon. Okay, United Airlines. I had to pick one jet stock. I was like, well, people still have to go on jets and travel. I know it's risky though, because if oil prices go up, jet stocks will lose their margins. So as jet fuel increases, this was at the time before we knew the war was happening, right? But I took a chance and I said, well, even though I know crude oil is going to keep on rising, I didn't know it was because the war was going to push it up and spike it, but somebody will win the battle in airplanes, and the winner is always going to be United at this point. Since COVID-19, they've managed their books well, I think. So they always look like they're the best performing airlines in terms of stock chart performance, but it's very volatile though. As you can see, it went down to 90. So at some points you were losing money on United Airlines. But like I said, I picked stocks where you could just close your eyes, stick thumbs in your ears, don't care about the news, just hold 6 months, at least 6 months, hold it. And we're fine. So we missed the top. You could have sold early at 130 plus. Now it's back down below 120 a little bit. So it's around 120. You got 15%. That's fine. All right. Not perfect, but good enough. How about this one? Pipelines. I got another natural gas. It went up into March and then went sideways after that. So I don't know. This could be a loser or it could be a winner later. I haven't decided. Baker Hughes just reported earnings, I think, this morning. And looks like we're good. We have good earnings. So this thing should recover. It's up 8% now. We used to be a lot higher during the April-March area, but up above like 70 to 70. So we were $10 ahead. That's fine. And one European chemical company, I guess this is to match with Corteva. Corteva used to be like a European company too. Then they got spun off. So they used to be part of some German or British chemical company and they got spun off. It's US only. It might have been during the World War II or something. Don't remember that. I guess they couldn't make Zyklon B. So anyhow, we got that done. And then we have a steel company from Germany. This one, very volatile, very risky. It was up going into February. Then when the war started, the cost of making steel in Europe went up. It crashed with it. So a lot of these steel manufacturers, defense companies in Europe got hit. Went down into April, but recovered. So we recovered. We're up 6% now. I don't know if I want to keep it or not. Next Era Energy reported earnings last week. It's been going sideways mostly, 2.84%, very weak. McKesson, same thing. It's a nice long-term stock, but this year has not been doing well. MCK, I don't know. You guys been asking me, hey, should I buy the dip? Should I buy the dip? I don't know. Hard to tell, right? Hard to tell. So far, if you bought that dip, I guess you're okay. Now we're going towards the losers here. Royal Caribbean, best cruise line. We got some copper not performing well. The Banco de Chile. So we have a South American stock right there. Finance. We have CEMEX sideways. Another problem here. I don't know if we want to keep it. This is Mexican Cement. Enphase, one renewable energy solar type stock, failed. It looked like it was about to do good in May. It was popping up to $70, and then it just rolled right back down below 40. And then we have some risky players here. I had one aluminum. This one had a peak too, and it fell off. It was up like 80%, down 50% from that high. AstraZeneca will report earnings. I think it already did. It might have reported earnings this morning. I don't know, or maybe later this week. I think it did report earnings because I don't see a date on the right here. So maybe it already reported earnings. Anyhow, don't know if I want to keep that either. So there's some losers down here, right? So how many losers we got? 1, 2, 3, 4, 5, 6. 6 losers. Okay, 6 losers out of the 28. Not bad, not bad. Now, let's see how it performs against the S&P 500. That's what we're looking for. This is not enough to determine if something is a winner or a loser. You need to compare it with the S&P 500. So if I just bought the S&P 500, these stocks have to beat that too. It's not good enough to be like you made money. You had to make more money than S&P 500. That's how you determine if you really beat the game. The game is always a competition against a benchmark. The benchmark is the S&P 500. That's what most people buy. Most people just buy that and hold that. So if you're going to go outside of that paradigm and pick and choose stocks, you need to be able to pick the stocks that beat the S&P 500. That's the game. So we're going to do this. So we're going to compare it to the S&P 500. And I'm going to do 6 months here. I'm going to sort it by 6 months, okay? I'm going to eliminate these. All right, so I'm just going to look at the 6 months right here. That's the one all the way to the left. Okay, so what we got? What we got here? Okay, so Air still beats it all the way down to ThyssenKrupp. This one barely beat the S&P 500. All right, this one barely beat it. Now, how many losers we got now? 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 losers compared to 9 losers out of 28. So about what? 2/3 of my picks were winners. Okay, good. That's fine. Can we improve it? Yes, of course we can improve it. But like I said, the whole point of this exercise was, can you just do something dumb where you just look at a bunch of stocks based on their charts and pick out something that someone who's like 50 years old or older, who doesn't have time or doesn't want to waste time, or these people are better off not even looking at the news. Okay, a lot of people, they make the big mistake of following the news. Once you hear it on the news, it's too late. You have to be ahead of the time of the news, or else you're just gonna ruin everything. That's what's gonna happen here. Okay, so that's what I'm giving to you guys. That's all I got. Perfect. What else? Nothing here. Okay, so that was the experiment. So I'm gonna think we're gonna go forward with this. What else here? Nothing. I'm gonna do the real estate REIT, real estate investment trust. So we did this one like about a month ago, right? A month or two ago. So let's look at the 3-month performance of these stocks here. So far, we only got 3 losers. I actually added a couple, like this one, Digital Realty Trust, and I think American Tower. I added 2 data center type REITs to this one. I already had 1 or 2 data center type REITs, the Iron Mountain one, but I've added 2 more. Okay, because one of them already had earnings, so I said, okay, I'll add a DLR. And then we have one that's reported earnings tomorrow. So we'll see how this AMT does. AMT also does cell phone towers. So they lease out land for cell phone towers. They make money that way. Okay, so far we got like a lot of good picks here. from 3 months. Now let's look at the performance level. Let's see who are the winners here. So based off of this, only 3 losers here. 3 losers here. So even though DLR didn't really make any money, it went sideways. If I just did a comparison to the S&P 500, we're still outperforming it if you bought it about 3 months ago. So good. This is good too. So I think the strategy of picking out certain things, certain like stocks, is working out. And this will be the start of the Substack. That's what I'm going to start out with. For the people that don't want to trade too much, that's the beginning. And then what else we were looking at? I was looking at steel and other things, right? More aluminum. So AA was not performing well, but there were other aluminum stocks that were performing well, like Kaiser Aluminum, Reliance Steel, and aluminum. And then we also got sucked into the titanium business here. So we have 3 of these titanium ones. So if I wanted to, I could have just replaced AA, Alcoa many months ago, because I saw the underperformance of Alcoa compared to these aluminum and steel stocks. So over time, I would have started replacing Alcoa and said like, well, I think I'm going to add these stocks into the mix of the Boomer portfolio maybe 2 months, 3 months ago. So that would have changed things, right, for it. So yeah, we're going to have to fine tune this a little bit, maybe use some AI to help out, say like, okay, we got some AI. Please look at my list of stocks that I pick based on volatility, based on other factors. Which ones of these would you drop? Which one of these would you keep, and then use some AI to pick it out for us. So just based on the charts, we have a list that we work off of. And then from that list, we narrow it down with the AI. I think that's how we're going to go forward in tuning this up. All right. So this little tweet here, I think this encapsulates the problem that people have. A lot of people now are very short-term in their thinking, right? If you're short-term in your thinking, you're a trader. You're a pure trader. But you also have to look at the different time frames. All right? If you listen to Joe Rabel, it's like, this is the higher time frame. So if you look at the higher time frame, a stock is moving up because we're in a bull market. If you zoom out, this is what the stock looks like. Right? So if you bought like a year ago in April, you're fine. If you bought it like 10 years ago, you're fine. This is what it looks like. But if you're a short-term thinker, this is what it looks like if you bought at the top 1 month ago. If you bought Micron at the top, if you bought SanDisk at the top, this is what your portfolio looks like. If you bought Qualcomm, if you bought AMD or, AMD, no, it doesn't really look like this. AMD looks and Texas Instruments look better than this. But let's say you bought ARM, right? You bought something like that. This is what your portfolio looks like. It's like you're losing money right now. You're like, what the fuck? What the fuck? Where's the bottom? Where's the bottom? And you're panicking. You're panicking. Today you're panicking, right? You're panicking. We got earnings today. I mean, not today, but in a couple days. We also have Kevin Warsh is going to speak again at the Fed. You're really worried. This is what you look like. This is what your thing looks like right now. It's going back down. Last week you're like, oh, it's recovering, but well, what happened on Friday and today? Now you're back down. You're back down to that next bottom. It's not looking good. If you bought SpaceX, where are you right now? It looks even worse, right? You bought SpaceX at the top. What do you think is going to look like? No. So that's really going to affect your psychology on how you treat the stock market. To you, it feels like hell. Now, here's the other thing we have here. So before the weekend, people were like, yeah, we're going to war again. Everything's getting worse in Iran, in the Strait of Hormuz. And what happened Friday night? Well, Friday night to Saturday morning, everything calmed down. Iran says it has halted retaliatory strikes against the U.S. after President Trump called off U.S. strikes for a second consecutive night. And on Sunday night, you saw oil, Brent crude crashed 8%. U.S. oil, WTI, West Texas Intermediate, it was down 6%. And so, last night you probably thought, oh, we're just going to be fine today. Well, what happened? The market opened and everything you gained overnight disappeared in an instant, in a flash. It just went boop, gone. So NASDAQ collapsed. We're lower. I haven't checked what's been happening the last couple hours, but last I saw, it was down. So what are you going to do about that? It looks like this thing doesn't work anymore. Every time Trump goes to war, you go down a bit. But then when he calls off the war, it pumps higher. It didn't work this time. Why? Because this time around, all the stocks that moved up on earnings last quarter still want earnings now. They want to see what these companies actually deliver. Last 2 weeks, no good. Google, nope. Google wasn't it. It didn't give the results that people wanted to hear. So since Google reported, it ain't working. This ain't working no more. All right, and what else we got? Oh, somebody claims that this was the reason that all the gains disappeared in the morning. So somebody reported, the media reported this. China starts mass producing homegrown deep ultraviolet DUV chip making tools, an advance for local chip industry. A Chinese state-backed company has begun manufacturing one of the key pieces of equipment used in chip manufacturing for the first time, a key development in Beijing's drive to reduce its reliance on foreign technology to make chips. Well, that's not extreme ultraviolet. Okay, EUV is way more advanced than DUV. I guess that's something for China. Okay, that's still an improvement for China. Is it worth getting scared about? I don't know. But the timing is interesting, isn't it? They decide to dump this report just as the market opened. How convenient. So like I said, when we get to earnings seasons, expect shenanigans. Don't trust anything. They're going to try to add volatility as much as they can because it makes a lot of money when you do short-term trading. As a long-term person, though, this is not cool, right? So that's why when I pick the boomer stocks, I try to pick stuff that I feel won't be shaken around as much because of this quarterly, monthly shenanigan business, okay? And you're going to have to suffer through it. You have to choose right now what you want to be. Do you want to be a long-term person? Do you want to be a short-term trader? Or do you want to do both? You can do both. You can do both. I do both. Like when I do anything long-term, I pick a very few select stocks that I feel are very good. And I mostly park my money in NASDAQ 100 or S&P 500 ETFs. That's it. I don't need to spend as much risk or time doing short-term trading. I only do it because, well, it's fun to do from time to time to gamble a little bit. It's also interesting to see if you can beat the market for a while. It helps stimulates the mind. And I'm showing you that you can do it without any fancy subscriptions to websites that give you special data. I'm just doing it dumb. Everything I did right there, you could do for free. Okay, that's what I'm trying to tell you guys. You're lucky. You're at the point where AI hasn't come in and taken all this stuff away. Once AI gets fully adopted by these trading houses, and a lot of people that are individual traders and investors also are using AI as we're talking right now to improve their edge. The more and more AI they use, the more this stuff will stop working. Okay. So, and all the options market and 24-hour trading and crypto tokenization of the stock market, all this stuff is coming too. And once everything gets settled in, you're going to have a harder time finding that edge. So learning this stuff now, using this stuff now is going to be important in the next 10 years because you'll be ahead of the curve. All right. At least you're starting with a baseline methodology that can work in most cases. So you don't have to struggle and hunt for like some exotic, esoteric way of beating the market. No, you can just do something as easy as I just said. Use AI to kind of fine tune it, to improve it, to adapt to the prevailing conditions, and then you can win too. It doesn't take much to win above the S&P 500, as I showed you. Like this crap was easy to do, right? I just gave you that boomer portfolio. I didn't try to like beat it completely, but just with like a very basic rudimentary knowledge of reading charts, this is enough. This is enough for you to continually, consistently beat the S&P 500 over every period of 6 months at each given moment. And that's all you need. Once you get that, you're done. You're done. You can be like me, lazy, sit in your ass, just go like, oh, what should I pick? Let's pick this one. Let's pick this one, and then you're fine. Look at that. Some boring stocks like these, and you got it. I didn't look at the list. I didn't pick any crazy semiconductor stock. I purposely avoided those semiconductor stocks. I only put one of them here, like Air, because I like Air so much. I left it in there, but I strictly avoided software. I strictly avoided semiconductors because those are high volatility. I know if you are a 50-year-old and you hold like something like SanDisk at the top, you'll be scared, like, and freak out. You'll really freak out. You're like, oh my God, it's down 50% in 1 week. If you're a 50-year-old, your blood pressure will not withstand like a SanDisk. Okay, so no SanDisk for you. The best I'll give you is Air. That's it. No AAOI, no SanDisk, no Micron, none of that stuff. That stuff is scary for most people, and you could do fine without anything that really screws it up. So high beta stocks like that should be strictly avoided. Okay, if you want to add the high beta stuff, we're going to make another portfolio where it's higher risk. Okay, and we're going to do different grades and levels for different people. Hey, yo, SCHD up 23% year to date. That sounds familiar. SCHD? What is that one? Oh, dividend equity ETF. Okay, now I know why it sounded familiar. Yeah, let's compare it. So let's see, compare it to the S&P 500. Let's see. It gives you a dividend. That's nice. It gives you 3%. That's nice. It pretty much matches the S&P, right? Yeah, it looks like it's trying to match the S&P for the most part. Yeah, there's definitely so many ETFs now. Like a lot of like covered call ETFs. I remember Kyle was talking about one of those Bitcoin covered call ETFs. Oh yeah, that one might be interesting. We're gonna have to look at those some other time. Like construct like a portfolio just of ETFs. Okay, what else? Yeah, so this is the news this morning. ASML Holdings slides after a report of China beginning DUV tool production. I feel like this news wasn't really the reason for this, though. It was just like an excuse for it to go down. It looked like it was going to go down anyway. I didn't feel like the pop from last night would hold. You're gonna have in 2 days, we're gonna have the Federal Reserve, Kevin Warr speaking again. You're gonna have in 3 days, you're gonna have like the results of all these stocks, these big name tech companies. So why would you hold it on a Monday? You know, anything you made money from buying the dip on Friday over the weekend, you would have dumped it all in the morning anyway. I think this was just an excuse to explain why it did that. So ASML Holdings shares slid to the lowest since early June after a report that a Chinese state-backed company has begun mass producing certain chip-making machines, which could present a potential threat to the Dutch firm's sales. The stock fell as much as 6.6%, having traded higher throughout the morning in Amsterdam. A Shanghai-based company has started making immersion deep ultraviolet lithography tools, DUV. The information reported on Monday, citing unidentified people familiar with the matter. China's contribution to ASML's net system sales fell to 14% in the second quarter from 19% in the preceding 3 months. Veldhoven, Netherlands-based ASML, which counts Taiwan Semiconductor Manufacturing, TSMC, and Samsung among its customers, didn't immediately respond to requests for comment. So, I don't know. That's an excuse. Those covered call ETFs are interesting short-term, but the gains are capped. Yep. Welcome to the options game. Welcome to the options game. That's what... So, this is why I don't do options. Because there's a lot of subtleties. When you do ETFs that automatically do these option strategies for you, you don't have as much control. So I feel like it's better you just learn how to do options yourself. And if you take the list of boomer stocks I gave you, you can take the list and look at the options available to trade for these tickers and develop your own covered call strategy or hedge strategy or whatever, iron condor, I don't care, right? In this show, I just do everything basic, right? I just do everything basic, and it's up to you to go further and develop your own ideas from it, you know? I think that's the way you should approach things. I give you the basic, most rudimentary thing that anyone with barely any stock knowledge can do. Anybody that can just click buy and sell on their brokerage account, you know, all you need to do is buy and sell, right? You don't need to do any fancy shit with the options. If you just do at the very minimal buy and sell, then from there, once you get comfortable with that, then you can move on to options and go like, okay, I want to hold like something like Caterpillar, but I know Caterpillar is going to be weak in the next 6 months. So in the next 6 months, if it goes sideways, I still want to make money, or I want to hedge in case it drops, then I'll buy some puts, sell some calls, do this or that. You know what I mean? So on the fundamental level, you just need to know the basics. And then from there, once you get comfortable with just doing buy and sell, and you feel like I mastered that, and you want to learn more, then you can go to somewhere else, watch some other guys' YouTube videos and go like, how do I do covered call? How do I do iron condor? How do I do this and that? What's the best way? And then that's how you would do it. Yep. QQQI. There's so many. There's so many of them. Not just, yeah, there's so many options. Just like the leverage ETFs, nowadays you have a lot of options. Not like when I started trading. When I started trading, there were only a few ETFs. When I only did it, it was only a few ETFs out there. Now there's so many. There's a universe of ETFs. Yeah, you can figure it out. So, yep. That's how the hedged JP Morgan S&P 500 ETF works. So the people that bought that ETF, the JP Morgan hedge ETF, last quarter, when the stock market kept going up because of the semiconductors after mid-April, they got capped. They didn't get any of the gains after April 15th. After April 15th, when Trump did the taco, they didn't capture most of that tacoing. All they did was capture like the first couple weeks of the S&P 500 going up, and then after that, they got capped. They didn't get any of the gains after that. So if you bought that ETF, you got trapped. You got trapped there, unless you sold and went somewhere else. Yeah, so that's it. Yo, what's up, Garian? All right, so that's it. That's all I wanted to say. I'm telling you guys, you can do a lot with just a few bits of knowledge. Very few. All right, let's look at this why coffee and stuff here. So I'm looked at one of the semiconductor ETFs. Which one was this one? I think this was the PSI ETF. And I was talking about this last week. Okay. So this was one of the possibilities, right? One of the possibilities was that the semiconductors could just pump up and we'd be okay going into earnings, and then the earnings would push us up even higher and we'd be good. Did that happen? No, it didn't happen. We went up a little bit, but we completely failed and we went back down. So what do we do now? What do we do now? It looks really bad right here. So let me get that chart up for you. Let's see how it looks. It looks horrible. Like I said on Friday, it's gonna look bad. It looks like it's continuing to look bad. I haven't looked at it since this morning. It already looked terrible. So let me open up that chart. Let's get rid of this. Yep, it still looks bad. Holy crap, it looks bad. All right. This market looks horrible, man. It looks so bearish. What are we gonna do? We're gonna crash right here? Is this the week that we crash for good? Is it over for us? Okay, so this is the QQQ. Here's the QQQ. Here's the daily. Look at this bad boy. You do not want to see this type of candle. Look at that. So after Friday's dump, we opened a little bit higher, right? We opened a bit higher than the body of Friday's candle. So if we just look at that, all we did was open up here, barely above the body of this candle. And after that, we just went straight down, and we haven't did jack crap after that. This is the worst looking thing I've seen so far. We haven't had such a bad looking candle since probably this thing right here, right? This thing right here. This thing was the worst thing, right? And so that's it. This guy, I don't know what to say. All it's gonna take is a few bad earnings, and this thing will just completely collapse. All you need is a few bad earnings. We have 5 big major earnings Wednesday after the close. You don't need all of them to be bad. You just need the majority of them to be bad. And Kevin Warsh is speaking just before that too. If he talks and the earnings comes out and they're all bad, woo! See ya. We're going straight down. The NASDAQ is going straight down. We're going right back to where we were back when we had the taco trade, April 8th. So I don't know if Trump really has a plan here to try to taco his way out of this, or we're just going to completely fail. Doesn't matter what tacos goes on. I don't think there's any kind of taco. We're just gonna die right here. So that's it, guys. That's it. Okay, so let's look at the chart of the PSI. This is the most risky of all semiconductor ETFs because they rotate 30 stocks and they pick like the most aggressive, high momentum stocks out there. And if you look at this in a traditional manner, you go like, this is a head, this is a head, these are shoulders, 2 shoulders, a head. Okay, this is what it is. So I can draw a head right here. I can draw like some frowny face. This is a frowny face. This is their this is what it is. This is gonna be like this, right? This is gonna crash and burn and go right down. That's what it looks like. If you just base it on simple technical analysis, if I just look at that, look at this. This thing doesn't look good at all, man. We're gonna die. We're gonna die right here. The only way we're gonna recover is if it like does a false dip, right? Like right here, back at this low, like it just goes down here and then zooms all the way back up. That's the only way to survive this. Like we make a false breakdown, people start buying it up right here as it's falling and then push it right back up. That's the only way. That's the only way. So that's what I'll be looking for. in the coming several days. I'm gonna look to see if there's something worth buying there. If there's nothing worth buying there, like I told you before, you know what I would do? I would start planning to really short Micron. So I was hoping Micron could get close to 1,000. I would have short there. This is where I would have been shorting. It got kind of close to it. And SanDisk about 1,800 was where I said like it was good to short somewhere around here, but it already rolled over before it even got close enough to that point. It's already rolled over. This thing looks terrible. The next point to buy SanDisk is about 900. 900 will be where you would want to buy it next. And even then, after you buy it at 900, it's probably going to go sideways. I do not think it's just going to bounce like this. Like, this is going to require a lot of help from earnings from the other companies first. Okay? By the time it gets to earnings next week, you need all the other guys' earnings to be good. So let's say Kevin Warsh crashes the market and this thing goes down here before the 5 earnings. You could buy it here at 800 before the earnings and hope that South Korea will report earnings Tuesday night. Tuesday night, you'll get South Korea SK Hynix earnings. That thing could crash this thing, right? It could crash this thing down here. You could buy it up here before Kevin Warsh speaks. If Kevin Warsh speaks, it starts moving up, and then the 5 earnings moves up, that would have been a good buy. So you have to strategize. You have to go like, I don't have a crystal ball. I don't know what's going to happen. If SK Hynix crashes this, then I'm going to look for a target at around 800, 900. 800 to 900. If you want to gamble, that's where you would gamble. That's it. Zeta. I don't know. What's Zeta? What the heck is Zeta? It looks like it's just a random penny stock. This thing looks like a random penny stock. I mean, it already does this. So yeah, I mean, I don't think it needs news to move up or down. It looks like we're gonna have earnings on this stock in next week. So what the heck does this one do? Marketing technology. Oh yeah, it's a software company, so it's just moving on software. So if you didn't notice today, there's one sector that's going up. So what's that sector that's going up? Software. So if IGV is going up and there's no news, then it's just going to lift all the boats. It's just going to lift all the other software companies. So you can look at Palantir. It's up, right? Same reason. Why is Palantir up? There's no news. It doesn't need to have news. It just has, well, people just feel like it's time to buy software now because semiconductors suck. So I'm going to have to move my money somewhere else. Like I told you guys, when you own a big hedge fund or investment portfolio, they are not allowed to go into cash. Okay, they are capped into how much cash they own. They're not like Warren Buffett. Warren Buffett is all into cash. Like everything he sold right now, he just stayed in cash. He just bought treasury bills. He bought money market. He's in cash. But any other person, they are not allowed to have more than 10% of their portfolio. That's the rule of thumb in the industry, to be in cash. So if they sold semiconductors, they have to go somewhere else. Where else would they go, right? Okay, I sold my Micron. I sold my SanDisk. I guess I'm going to buy software because now I'm underweight software. So then they go to software. That's probably what happened. That's it. That doesn't have to have any news. There could be news, but it doesn't have to have news. So if they're taking money from somewhere else, it has to go somewhere else. That's really how the game works. And so you're always on the lookout for software and all the other tech companies, because they probably are like, I have to have a minimum amount in tech. If I take away from semiconductor, I have to go to another tech. So the other tech that's weak right now is software. I'm going to go to software. Same thing if people are in Asia, right? If I have a certain percentage of stocks in Asian companies, if I take away from South Korea and Japan, where else do I go? Well, what's weak right now? China. Okay, I sold SK Hynix. I sold Samsung. I sold Konixia. I sold Sony. I sold Nintendo. Where do I go? I sold Toyota. I'm going to go to the Chinese stocks. It doesn't mean that the Chinese stocks are good. It just means that I'm required to have certain percentage of my portfolio exposed to Asian stocks. I have to have a certain amount exposed to European stocks, something like that. So all these guys have rules. You don't have those rules. You as an individual investor can go anywhere you want. So, and the other weak Asian stocks are Indian stocks right now. India is very weak, is another weak area. Now, would I recommend Indian stocks? Nah, I don't know. I never liked like Indian stocks. So let me see if there's an Indian ETF we can look at. Yeah, India ETF. I don't think there's many. There's like one India 50, India, MSCI India, small cap India. There's not too many. You know. Okay, let's look at the broad one. Usually I look at this one. So, yeah, this thing has had a terrible time since the Iran war, because India requires a lot of oil from and energy from the Gulf. So ever since the war, these Indian companies have really gotten their ass kicked. Would I buy Indian stocks? No, I don't know. I'd rather just do Chinese stocks to trade. I don't know about Indian stocks. So these aren't really something I like to look at. Yeah, so that's tough. That's tough. Let me see what these other ETFs give me. Let's look at the growth one. Growth leaders. This one looks a bit better. Okay, so I guess these are tech companies. So after the dump here, it recovered, but like this whole thing since 2024 is like, dude, I'm not liking this. I mean, I don't know. Maybe this looks a bit better, but Indian stocks are worse than Chinese stocks in a lot of ways. Yeah, SAR. Maybe you can make your own ETF. Making ETFs is a good business plan, business model. You can get some fees. You can sell people ETFs. That's how Wall Street makes a lot of money. They charge you to hold their little ETFs because people are so lazy. Yeah. That's just how it works. I don't know. I'm not really a fan. I'm sorry to say. I mean, I'd rather buy these Chinese stocks I told you about last time, like KC. Let's see. Is KC ready to go? Is it ready yet? Doesn't look like it's ready, but maybe it'll be ready eventually. KC, man, that's my Chinese stock du jour. That's the one I like. Look at this. Boom. Once we're done with this range, we're going to fly. We're going to fly to the moon. $10 to $70, no problem, right? Oh, we're going to $70, baby. Okay, let's look at this. So this is the dispersion index. Dispersion. So it looks like we're still going down from the top here. Ignore all this volume stuff. We're not looking at the volume right here. I'm just plotting. I just want to plot the overall dispersion index. It looks like we're yeah, I don't know. This doesn't mean like I want to buy anything right now. That's what it means. That's what this is telling me. It looks like we're gonna crash hard. That's what it tells me right here. Okay, so that's not something I'm looking at. All right. What else? What else to look at? The PSI, right? So let's look at the semiconductor thing right here. So like I said, this thing looks bad. If you look at the volume, we had high volume over here at around 153. Another volume here around 168. Okay, then we had another high volume area in February 13th, around 94. So it looks like we're about to crash and burn, go down to 94 again. So that's why I was saying this is not going to be good. If we look at the SMH, let's look at another. This is more popular. This is the most popular ETF. I would think this area is the problem, right? This is this one. Like the volume start getting more pronounced over at this area here. May 6th. May 6th is when we started getting increased volume. And if this breaks at this 536 level on the SMH, that's going to be bad. So let's look at the, how about the SOXX? This is the one I usually look at. We have two high volume areas around 546. As you can see, this next leg here, this is huge. We got huge amount of volume going into the final bottom of the Iran war before it moved up. Will it happen again? Will this thing be the catalyst for it to go up higher? Is this the end? So are we going to have a little whoop? Is this what's going to happen this week? So if you're a bull, watch the SOXX. Watch this. Is this going to happen? It's going to bounce off the bottom of this rectangle here. Okay, or the top of this rectangle, whatever. I don't know. It could go deep into the rectangle. Heck do I know. It could do that instead. If it does this, this is where you want to buy. This is where you want to buy. So this should match with like the SanDisk or the Micron. If you really feel like this is where you want to be, this is where you want to get in. So if Zeta would benefit from a rotation from chips to software and it's high beta, wouldn't it make sense to own as a sort of hedge for chips? Or am I doing too much? I don't know. That's high risk. That's a lot of assumptions, right? This is why when you look at charts, you're just making up a story of what you're seeing. You kind of are guessing what's going on. The people that are in the know, that have like the subscription to the options flows, that pay money to have access to internal data from the brokerage firms, that have the dark pool data. So you need the dark pool data, you need the brokerage firm data, you need the options data. With all those other pieces of information, you probably can make that call, right? If I'm just looking at charts, which is free information, I'm just making an assumption. I'm just going like, okay, I see IGV going up today. I see semiconductors go down for 2 days. And I'm just putting a story in my head going like, that's my theory, my hypothesis, based off of free information. And yeah, I guess you can make that. I mean, I would probably buy software because like I also look at Sky. Look at Sky. Sky. This looks good. Right? This looks good. So we're about to close this. We're making a higher low. Right? We're making higher lows, right? This move here looks like it's about to end. It's about to end. So Sky looks good. Cloud looks good. Okay, these are the more outperforming sectors of software. This looks like it's about to go. We can look at bugs, cybersecurity, which is still the winner. This guy, it's like there's a lot of volume that came in on Thursday or Wednesday last week. Why did that happen? Are people going to push this even higher? And then you have the loser, IGV. IGV is the worst of these guys, right? But this one, it looks like it's trying to improve. So is Microsoft going to make it? What's going to kill this thing is Microsoft. Microsoft is the big software earnings this week. This will report on Wednesday after the close. This one has to win. And there was a lot of volume here. This is unmistakable volume. So people want to defend this level. They don't want Microsoft to go below 360. They're going to keep trying to push it up. But if that earnings comes out and this thing goes straight down, it's over. It's over for IGV. Everything in IGV is gonna die. Everything in IGV is gonna die because we already had Google. Google is not in IGV. Google is in the communication services sector. But Google also does software, also does hyperscaler, also does services outside of it, right? So Google and Amazon, they're outside of tech. Amazon is considered a discretionary stock, and Google is considered a communication stock. But Google is also, has ties to software. So there you are. It's kind of hard to decide what has the most influence. Microsoft definitely has a lot of influence. And if that thing fails, goodbye everything else. We only had one major software company report earnings last week. That was Now. The other one was IBM, but IBM already pre-released its earnings 2 weeks ago. IBM dropped 20-something%, right? So IBM was already crap. We could ignore that one for now. So outside of IBM, Now was the next one coming, and it reported earnings. It looked like it was going to go down a little bit, but it got defended here, the same low as we got back in June, and a bit higher than this. You can see the volume coming in, these two, right? This area here is very important. So whatever was the price at $85 to $90, it's a very important level for Now. And so far we've been recovering. Friday we were up. So semiconductors was going down because of Intel and other reasons on Friday, and Now was recovering, and then today it's recovering even more. So yes, if you go back to your theory that if you want to pick something high beta and if you believe Microsoft isn't going to kill IGV, then yeah, you would buy Zeta. You would take the risk and buy it. That's up to you. Yes, that's it. You think Microsoft depends on their CapEx guidance? Yeah, Microsoft has the same problem as Google because they spend on AI. Microsoft, Amazon, Meta, and Oracle, right? IBM, Google. Who else? There's some others, but those are the big ones. Those guys are the ones that really matter. Yeah, big capex would be good for the chip makers. That's it. But even now, the chip makers are not doing well, right? They're reporting good earnings, but even they're getting punished. People don't want to pay for that price. They're looking at this stuff and going like, "What the hell? Why do I want to buy Intel at this price? Why do I want to buy like Nvidia at this price?" Because Nvidia like announced over the weekend that they are spending money to Anthropic. They're putting more money into Anthropic, OpenAI, or whatever. They're spending too. Nvidia is spending. Nvidia wants to help these chip making companies go up. I mean, so it's a circular motion. The people that are buying the chips are giving the money to the semiconductors, and the semiconductors are giving back the money to these AI companies to help them grow. So now you have Michael Burry and all these bears come out and go like, this is circular funding. This is circular funding. You make money, you give it back, and then they give it back to you, and you give it back to them. All you're doing is like trying to make it look like you're making money, but you're not making money. All you're doing is making more debt towards each other to grow everything. So that's it. Then some Chinese AI. Yeah, I was going to talk about that over the weekend. Kimi K, whatever. Overall, they weren't as good in performance as the US models. That's what the results were. But it's free, it's cheaper. I mean, not free, it's more open source, it's cheaper. So you have that. All right. Anyhow, that's it. That's all I have to say. Okay, we're good here. Yeah, we're good here. That's all. That's it. Okay, so that's it. Very easy to understand. Nothing to worry about. So let me get the calendar. Let's look at the calendar. Let's see what's next up for us. I gotta get this. Okay, I got that. Okay, good. All right, so there we are. Okay. Now I'm going to all right. Okay, Baker Hughes reported, AstraZeneca reported, but we didn't see much movement on AstraZeneca, so I don't know. I'll have to look at that. And after the close, we have APLD. So that's one of those HUT, NBIS type companies that are going to report. Celestica, some energy infrastructure companies, that will be important. NVTS is a semiconductor. Nucor Steel, that's in the boomer stock list. Rambus, RMBS, another semiconductor. And Amcor, AMKR, semiconductor servicing company. So we have some semiconductors, some micro, neo, scale, blah, blah, blah companies to report their earnings after the close. Then tomorrow we have one refinery, Dyno, HF Sinclair, Corning, the glass manufacturer, important for laser optics and your iPhone, Samsung glass, very important there. You have some little Coca-Cola, KO, UPS, that might say things that might scare the market. PayPal, they might say something about the buyout offer they got in the morning tomorrow. And you have Boeing, BA. Okay. You also have Royal Caribbean. Again, that's the best cruise line stock. I picked that one because in the boomer portfolio, because it was a good stock to have during COVID. It doesn't seem like it's doing well this year. I don't know if I want to keep it or not. Might kick it out after the earnings tomorrow, right? We're going to have to decide which one we get to keep for the next 6 months. This is what's going to decide that. And then tomorrow after the close, we'll talk about these other ones like Bloom Energy, Seagate, Claw, Teradyne. Those will be tech companies. Did I pick Enphase in that boomer portfolio too? Yeah, that's another one I have to kick out, right? Enphase. If Enphase can't go back up, I'm kicking that one out. It's done. Okay, that's it. That's all we got to look forward to. If you care about Ford, if you care about Avis Budget Group, like those used to be some popular stocks people traded before. We have Visa, Tilray, so marijuana and credit cards. I don't know. I don't play credit card companies. I feel like they're boring. They're too boring. They don't really outperform the S&P 500. Okay, so that's really what's going on there. I don't really like them much. Blah, 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 blah. That's it, right? Okay, let's look at the other lists. Nothing new there. Unilever. Oh yeah, Unilever is important for some boomers. That one. Sherwin-Williams, the paint manufacturer. That one also can be interesting. In Hilton, but I don't play those. All right. Welltower after market close. Yes, that's part of the REIT portfolio. So yeah, Welltower today after the close, that's going to be something I'm going to be watching. And then reminder, we will have earnings for SK Hynix at night. So 8 p.m. Eastern on Tuesday. You will find out what SK Hynix earnings will be. That will really determine things, because if the Korean market crashes on Tuesday before Kevin War speaks on Wednesday afternoon, that's going to hurt everything. Kioxia will be Thursday. Okay, Thursday 15:30, so that's 3:30 p.m. Japan time. That will be near midnight my time, so close to 3 o'clock, so 2:30 a.m. Eastern Thursday morning. You will see what Kioxia, the Japanese manufacturer, will be. Those will be important. So not only U.S. stocks, but you'll have the Asian stocks come in this week too. That they're not part of the S&P 500, but they're gonna really affect the S&P 500 indirectly. So be careful. If you're gonna trade, I told you guys to trade as close up to earnings as possible, but as we get into the meat of the earnings, as we get into the hurricane, you don't want to be doing this. I think you Bitcoin is actually doing okay right now. Bitcoin and gold is doing okay right now. So I don't know if I'm going to talk about them, but maybe I will. Yeah. Let's see. There you are. All right. Good. Anything else to discuss? Nope. Nothing there. Okay, let's see what else I got to wrap up. Got to wrap up some things. So we got through that. We got through that. Okay. So that's it. That's all I need to cover. All right. I think I'm going to play some of the Samantha LeDuc thing about the yen.
This short clip from my live trading room. You can engage directly with my fabulous team and me at leductrading.com for all our research and trades. Or for just my daily live streams, you can access via YouTube memberships. All links are in the description. Last but not least, what does this all mean? Big picture for a macro backdrop. Money goes home is starting to come into the picture. So this hit my radar, and this is what kind of prompted it. So I added on to this piece, which is why I got a little bit long. But Japan's big opportunity to bring money back home. What's that? You know how much money they have invested in dollars, in petrodollars, in treasuries? They're our largest partner. They're our, sadly, vassal state as it relates to cooperation in keeping the yen weak and as a currency to leverage lots and lots of yield chasing in the US market, alpha by buying the NASDAQ, etc. So this is something that could change slowly then all at once, where the rate differentials start to close. And all of a sudden we've got a situation where, we weren't really watching for this. But then everyone's going to be watching for this. But money goes home, yen edition. So there's also Gulf Arab nations that are under attack right now. I wrote about this back at the beginning of the Iran war, how this will be very important to their capex cycle. And they're going to have to repair lots of infrastructure. Maybe that money stays there and doesn't come back into US tech investments like it has been. Anyway, these are all things to keep on the radar. Even Besant, by the way, even Besant is threatening. This is Besant. This is him. He wants to keep illicit, well, of course, sorry, but it's true. Money laundering and illicit funding has been in play. Have you seen the thousands and thousands of Cayman Island shell companies? So he wants to dismantle, or he's talking about it, the financialization of US markets. I doubt it, but if he does, this is another situation where he's trying to get, or this would force money home for sure. There is a great article that I actually layered on top of this tweet, by the way. He's very bearish, but he's a forensic accountant I have followed for many, many years. And he talks about the shell companies in great detail that needs AI to summarize because his reports are ridiculously long. But he's basically saying China controls them. And this is the wild card that the market doesn't see. So don't piss off China. Anyway, the point is money goes home is not front and center. We're looking at earnings season. We're looking at FOMC. But I'm saying big picture, keep it on your radar. I think it will be a little bit important toward the end of the year and beginning of next year. And this is the bull case if big picture, the Iran war is successful for Trump, not for Iran, then the market will be pricing in that capture of oil revenue. Otherwise, we have a prolonged war in the Middle East that can absolutely trigger oil crisis that triggers the money goes home. Japan, Gulf Arab countries and the US policy that I just showed you with Becent. So that would basically be something that we talk about later, but US dollar recycling would very likely end if money goes home, Japan edition. I think that one is probably front and center, and why I'm watching the dollar yen so intently. And then another macro risk, rising yields. They're kryptonite to AI bulls. I talk about that. That would also cause money to go home even faster, but the then devaluation would lose its core support. But I will contend still, as I have been kind of pushing this theme, that high price and high risk, there are a lot of warnings about this topping pattern that could be a very significant distributive top, not the least of which is Iran war not priced in, oil shock, all that jazz. But more to the point, we've got a lot of themes that are revisiting from last year that I wrote about early. And that was actually when Trump came into power, the Trump tariff terrors, and then this drama with Iran this year. Money goes home revisited. It has not gone home because they're chasing the AI rally. There is still petrodollar dependency. There is still U.S. treasuries of size holdings. But I'm getting signals here that that is absolutely in the works to start reversing, not the least of which is Japan. And we'll talk about that because I think Japan is actually a bigger risk that's starting to grow. And we have this little situation here where even the Nikkei, right, which you know is kind of a mouthpiece for Japan, they're profiling 5 U.S. tech giants with their hidden debts soars to 1.65 trillion on opaque AI funding. So why are they calling this out? Why all of a sudden Japan, who by the way benefits greatly from our AI ecosystem, is now kind of like putting a magnifying glass on what's going on with the big data center leases, GPU supply contracts that all raise the liability flag at Meta, Oracle, etc. So what's kind of interesting about this, at least in my mind, is that we still have the bull bear argument that's going on underneath the surface of whether this is a bullish opportunity with semis and data centers and memory coming on down, or if it's bearish. But one thing that I notice is this is very much a kind of a reminder that the government wants investment in Japan. So this could also be a lead for telling their powers that be, if you will, big money in Japan that has come here. Again, rate differentials, all the things that we've talked about, financed in yen to buy dollars to invest in NASDAQ, is a big, huge trade that looks very much like it's coming under the microscope. And we can see policies in Japan that are shifting very much for that money to stay in Japan. Money stays home. Money goes home, money stays home. But I think that kind of backdrop is worth tracking, long story short. And this is just one example where I think that this headline here where the Nikkei is investigating Alpha, Microsoft, Amazon, you can read it, get access, Meta, Oracle, they all are basically 1.65 trillion in debt that does not appear on the balance sheets, which is more than 1.35 trillion they officially report. So we all know that the off-balance sheets are opaque. And what is fascinating, though, is that the Nikkei is writing about it. I mean, think about that. It isn't the fact, and I know you can't get access to this, but the point is, I'm telling you, this is something where the subtleness, the nuance of this being highlighted, not by the US market or media, not at all, discounted completely, but the fact that we do have this off-balance sheet debt and liability that is specifically focused on hyperscalers and Oracle should raise a little bit of a flag. The BIS is already. The international settlements has already raised this shadow, but they're always early, and that's not a timing tool. So anyway, I know folks are very focused on the quarterly earnings, and that's all very fine and dandy, and we've had 9 consecutive quarterly earnings, especially in tech, that have beat. And it looks, footnote of this whole point is that there is still a lot of opaque liability that is not on the books, that at some point will become an issue, especially in private credit and in the bond market. Number one trigger that I wrote about, literally on June 1st, I said, I see dispersion unwind coming, and we had it. June 2nd, it actually, remember my client post, dispersion unwind? Yep, remember that? And reverse yen carry trade, where the dollar yen, that's the second trigger. The dollar yen picks up and yen falls, dollar is bid. So right now, the dollar yen is pushing into a 162.8. That is the prior all-time high. What happens to a stock in blue skies? It has no resistance. So they're going to have to come in and do some yen intervention of size, right? That's what the yen shorts right now are worried about. And yet, what are they going to do about it? They are absolutely in an inflationary backdrop with, by the way, expanding loan growth. Jeffrey has written about. They need higher rates. They're going to come right over here. 10-year Japanese yield is only 2.7 right now. It's absolutely destined for greatness, whatever you want to say. But this is the next trigger that I had put on my bingo card back in June. And in June, we've gone sideways. June, July. We're at 3/4 of the way through July and sticking the landing, so to speak, of sideways chop into the summer drop. We haven't had this summer drop yet, really. I mean, we would have to get below 72, 72. So we started with dispersion unwind. We're moving to the reverse yen carry trade, and now we're looking at liquidity potential flowing out, not in, if in fact Warsh tightens and does his obligatory one and done rate hike that the market is not pricing in, would absolutely cause some disturbance in the force. That's all I'm trying to say. But this matters, and that's all I'm going to say about that. 162.8. You get this and stay above, your yen continues to fall. That is bullish, the dollar, and it is bullish. Yields and rising dollar and yields together are bearish equities. And then you add oil on top of that, and we're hitting 85. If we gap above that 85, there will be gnashing of teeth.
Join club to trade with Samantha. Scan this QR code or click the link in the description.
All right, so there you are. You got the Japan noise, and I think, yeah, I've been saying that on Twitter. Japan is coming up into focus. I think I also did some cycle analysis on Japan. Let me see if I did that too. I don't remember. I don't remember. We'll probably start talking about like Japan tonight some more. I'm gonna talk more about that. Let me see. Okay, let me see. This one. Okay, let's see. What's this one? Yeah, I did talk a little bit about this. I had some other tweet too with the unusual whales. So I mentioned this one. Oh man, let's see. I think I did that. Unusual whales. Let me see. Was it this one? Let me see. And I said like last week it was gonna be sitting at probably 170. 170. So the DeMark says we're gonna get towards 170. Like that's the target. It doesn't. I mean, we might not make it there, right? We could just crash and burn fairly soon, but that's where we probably will head up next. Is 170. Let me see. SK Hynix option flows. No, that's not what I wanted. Yeah, I don't remember. I don't remember where I put that stuff. Don't know if I can find it right now. Oh, bold action. Nope, that ain't it. Yeah, I'm gonna have to see if I can find it some other time. Probably later tonight I'll find it. But yeah, I was going back and forth with Samantha on Twitter about this. But that was last week. So it's gonna take a while to find those tweets again. This one, did I respond to this tweet? Okay, let's see. Yep, it was this one. All right. Okay. All right, I gotta cover this. But yeah, she had a lot of tweets. There's a lot of tweets talking about Japan last week. But yeah, I was already talking about this. Look towards Japan for the answers, blah, blah, blah. I said 170, right? This was what I said on like July 21st last week. And then even then, July 18th, nearly a week and a half ago, I said this. And I think this is the one where I showed the thing. Man, it's so hard to navigate this stuff now. Yeah, here we are. I don't know. I guess I didn't put like the cycle stuff in this thing, so we'll have to discuss that later. But here, like, hedgies are shorting the yen, Japanese are shorting the dollar. Implied volatility is low for the dollar. So yeah, we're ripe for it. We have conditions ready for an extreme move in the dollar yen. I just don't know which direction it's going to go, right? It could be that we go up and then go down, right? We go up and all of a sudden the Japanese freak out and the Bank of Japan caps it at 170 and then we crash from 170 and that causes a liquidity event happening towards us in the United States, and that will like crash the whole damn market. So something like that could happen. All we know is that something big is about to happen. That's it. That's all we know. It's either going to be a month down the line or 2 months down the line. So even outside of the earnings, something can happen very soon. If you're just looking at oil, if you're just looking at the earnings, that's not the only story out there. The next story up will be Japan. That's really what's going to happen there. Okay. And here we are. So this is what Samantha like put for me here. I wrote this. I tweeted this to her, I guess. I retweeted her thing. And then I put this in there. Besant and his government equity stake signals as a counter to China. And I read this article last week. So to remind you, this is what he said. Scott Bessent, Treasury Secretary of the United States, wants the government's growing list of equity stakes in U.S. companies to send a market signal. These are not to bail out the companies. So the government buying Intel or Dell or whatever, the reason they're doing that is to tell people, yo, these are the companies that we want investors to put their cash in because it's important to fight China. Okay? If you're going to compete with China, China doesn't play by the rules. China doesn't allow capitalism to pick winners and losers. If you allow capitalism to pick winners and losers in every aspect of your life, guess what? Guess what it tells you? It tells you that you should be a porn star, you should be a live streamer, you should be this or that. That's what capitalism would tell you to do right now, right? Does it tell you to be a doctor? No, that's stupid. You spend all that investment to learn to be trained to be a doctor when you could just open your pussy for like billions of dollars in cash, right? In Dubai. That's exactly what capitalism tells you. So allowing capitalism full reign is not going to work with a country like China. China enforces society. They enforce and regulate how it works, what to spend on. So this is what's happening. This is what's going to happen. And what does this have to do with China and all that? Well, yeah, I mean Japan and all that. Well, currency flows, that matters. That matters. All the currency flows, everything flows. All these things affect the global economy. So we're going to be watching these things. All right. This is what we're going to be watching for. All right. I think that's all I want to say. I can add more color tonight. We have a lot of other tweets, I'm sure, that I can go and talk about. China, Japan. But these will be things that will affect us, and Korea, right? Korea too. Taiwan. I think I mentioned a little bit about this, but I'm not sure if I actually did read this article. This kind of relates to these things. So yeah, last week, the Department of Research or whatever, I don't know, the United States Academy of Sciences, executive branch, blah blah blah. They made this pronouncement to the people, to the science community. This is what's going on. All right, so they want to give money directly to the primary principal investigator. So usually how it works before is that you would actually have to be a professor or be in charge of a government institution. And from the institution, you would write a proposal to the government, to DARPA, to the NSF, the National Security Foundation. What other organizations in the government would you apply for? I mean, DARPA and NSF are like the main ones that I remember back in my time in school. And so you would send a proposal for your project, your research project, and you would see if you get funding. Now they're going to cut the middleman out of it. You don't need to be part of a university, a research university, to get that money. You don't need to be part of a government institution to get that money. I could be an independent investigator and submit a proposal, and they would actually take the time to read it and give me money directly. So they'll cut off the middleman. So that's going to be bad for a lot of universities. A lot of universities get their funding through that means, because when you work for a university, they take a cut. Their cut will be to provide utilities to your lab, to provide your rent to your lab, provide maybe your janitor, custodian services, any kind of stuff like that. The government administration, like the HR people, those guys get paid off of these proposals because they get a cut first before you get a cut. And if you cut away the middleman, like if I just work from home and I said like, hey, I got an idea for research, give me money, then you eliminate that factor. So first, the U.S. Research system should prioritize the individual scientists over legacy institutions. If we are serious about expanding what our scientists can do, we must invest directly in American researchers and the bold ideas that drive them. Too much of our research enterprise has come to serve itself rather than the scientists within it. Federal funding agencies should support a broader range of performers, including a new generation of mission-driven research organizations to expand our scientific horizons. And these agencies should organize themselves around the interdisciplinary frontiers of science today, rather than the academic silos of last century. Second, the federal government should fundamentally change how research dollars are allocated, distributed, and assessed. Instead of a one-size-fits-all approach, the government should fund more flexible types of grants, including fast-track grants, long-horizon grants, and new mechanisms that allow reviewers to champion radically unconventional proposals. Federal research agencies should evaluate their own allocators, test new ways of making grants, and construct portfolios with the intentionality of a serious investor. So, in one hand, we are taking away capitalism from the markets a little bit by saying, yo, you should invest in a garbage company like Intel, because we need a company like Intel to compete with an Asian company like TSMC, Samsung, SK Hynix, right? That's one hand. That's what they're doing. On the other hand, they want to make research to be more capitalistic. So instead of having these like universities that do whatever the hell they want, like, let's be real, a lot of them do basket weaving, right? They do all kinds of research that have no type of return on investment. So if I have like, if I do research on how many times the N-word makes someone feel bad, that doesn't give me a return on investment. So you are introducing capitalism in one side of aspect of life and society, and you're removing a certain sense of capitalism from another. You see how it is? So we are trying to be more Chinese in this sense. Third, the federal government should set clear scientific goals and build the industrial muscle to translate scientific discovery into technological strength. The greatest technical achievements of the last century came about because leaders in government identified national priorities and marshaled the resources to accomplish them. As our competitors race us to capture the value chain of strategic technologies, including with tactics we should never countenance, we can no longer assume that the fruits of American science will accrue to our own people. Government must mobilize the full force of our enterprise around national challenges, clear the ground for American builders, and reunite the work of discovery and manufacturing across the country. Fourth, we must prepare our research enterprise for the AI revolution. AI will accelerate and radically transform the way we do science, but even the most capable AI models will be slowed down in the bottleneck of institutions and systems built for the last century. As we renew the infrastructure that powers American science, we must re-engineer it for the AI age. And even as AI compresses the time from question to answer, we will still need human hands to build the instrument or prototype. We must build that capacity too, investing in advanced manufacturing, the skilled trades, and the vast pools of talent and tacit knowledge outside the traditional academic pipeline. So there you are. Watch out, watch out, watch out, watch out. That is exactly what's going on here. Okay? So I read to you that. You can take a screenshot here. Take your screenshot. This is what I read to you. Screenshot that. Screenshot this. And we're done. Okay. All right. Let's get on to gold. Let's talk about gold. But I think you can see like everything is turning Chinese now. We are definitely trying to be Chinese. That is exactly what's happening. And it really falls in line with Trump's admiration for China in a lot of ways. I think he does like the technocratic ambitions of China, and we have to, if we are to compete with China, we're going to have to be more like China, just like China became more like the United States in the 80s through 90s. We are trying to be more like China in the 2000s and 2010s. That's how it is. I don't know what Europe wants to do. Europe is kind of like confused. Europe wants to be socialist, but I think they feel the pinch of China versus the United States. If they want to compete as a third party in the game, in the race, they're going to have to not be how they have been. And that's a tall order, I think. They've lived too long in the shadow of World War II under the Marshall Plan. You know, they kind of got too comfortable sucking on Uncle Sam's teat. Anyhow, here we are. Gold's a 20.5-month leading indication for yields. Near month gold futures shifted forward 20.5 months, so we can predict how the yields will act based on gold. This is the same technique I used to figure out oil was going to go up. So you had this signal, you had the relative strength signal, you had the absolute strength signal, you had all these things, and you had the commitment of traders signal. So you had a lot of different signals telling me that oil was going to do well this year. It didn't tell me that there was going to be a war, though. All it did was, like, there for some reason, oil was going to do well into 2027, and it was a good time to buy some oil and gas companies in late January, early February. Now, we're going to do the same thing here, but this time we're going to do treasuries. This week's chart is one that I show in almost every issue of our twice-month McClellan Market Report. It shows how the movements of gold prices tend to get echoed again imperfectly 20.5 months later in the movements of long-term interest rates. The Treasury Yield Index represents the current yield to maturity on whichever is the most recently issued 30-year Treasury bond series. I could substitute the 20-year yield in this chart and it would look similar. The key point is that liquidity waves which ripple through the financial markets tend to hit gold first and then proceed to other markets afterwards. So gold is always the first one to move. If you think inflation is going to happen, gold goes up. And then once inflation does appear, people always yell and scream, how come gold isn't going up anymore? Why has it stopped going up? Why is it going sideways? Why is it going down? Well, because the people that bought gold for the future bought it in many months to couple years ahead of time from what's happening in the present moment. So it's not a coincident indicator. It's not a coincident market. It's a ahead of time market. It's forecast things ahead of time, right? That's what it is. It is an anticipator of the future. So this is the same idea here now for treasury yields. For reasons I do not know, the lag time for those waves reaching the bond market is about 20.5 months. Gold was making a big spike up 20.5 months ago, and so the expectation is that the current big rise in interest rates should be peaking right about now. I could calculate the specific date, but that would create a misleading impression about the precision of this relationship. It is not as time precise as I would like, and it goes through periods when the turns in yields arrive a bit earlier than scheduled. And then in a few weeks, they are later than depicted. This is the normal relationship, and 20.5 weeks is just the lag time that gets the best overall fit. So it's not a perfect indicator, right? It's not perfect. None of these are. You need more than one indicator. All right, that's the best way to approach these things. This is just one signal. You got to match it up with other signals. So from here on out, we are going to look carefully at the bond market, and what Kevin Warsh is going to talk about in 2 days will also be important now, because this is the second time he's going to talk to the markets. So as we get a feeling for what Kevin Warsh wants to do, as the market gets used to the new Fed chair, you're going to see the bond market start reacting, you know, and then we got Japan and China and all that other crap also getting into the mix. How do they respond to that, right? The Bank of Japan will respond to what we do. The Bank of England will respond to what we do. The Bank of the Europeans will respond to what we do, right? The ECB, the European Commission. All right. So the model also does not tell us about the magnitudes of the moves as well as we might like. The dance steps are very similar. So this is only for timing, but the magnitude can be a lot different. That is just the nature of this model. And that is an important point to remember. 20.5 months ago, gold prices were topping just underneath $2,800 an ounce. Gold then went on to a nearly double in value by January 29th, 2026 at $5,508. This does not mean that the numerical bond yields are necessarily going to double from here. It does not work out that way. But there should be some noticeable response. First, though, bond yields are scheduled to match the violent sideways chop which gold patterns follows. That sideways period should last into mid-September, and then the big rise in yields is scheduled to start. So we're going to have a choppy time into September, so maybe something that will just push it back down, and then we go sideways, and then all of a sudden into the late 2026 quarter, right, the final quarter of the year going into New Year's, we start bubbling back up. Okay, so that's what we're going to be watching for. Here's another article from the McClellan Oscillator guy. Okay, this is the ratio adjusted summation index, RASI, plus 500. So we didn't hit 500. Failures thus far unfulfilled. So in this case, we did not have a strong push up from last, I guess, taco, April 8th. So April 8th, that push up from the March low, it wasn't strong enough for this indicator to get above 500. So what does that mean? So the ratio adjusted summation index, RASI, R-A-S-I, for the New York Stock Exchange accumulation and distribution line got up or advanced decline. I think it's advanced decline. I forgot now. Is it advanced decline or accumulation distribution? I think it's advanced decline. Okay, advancers versus decliners. Got up to 471 on May 8th of 2026 and then turned down. So that's as high as we got, 471. Failing to get up above about the 500 level is a sign that a rebound does not have enough energy to achieve escape velocity. So there was a lot of indicators like last year in April where we saw very strong recovery from the tariff tantrum. And that's why I didn't need to talk about any stocks anymore from April last year. That was the bottom. That was a significant bottom. That wasn't any normal bottom. That was a strong enough bottom that you could bet that the S&P 500 would go 20% to 25% in the next year on average. So you didn't need to listen to me. You just bought the S&P 500 or you just bought most of any stock. Very few sectors underperformed. Most things you bought on the stock market would have went up from April, May. It would just went shot up. No problem. But this time around, we didn't get a deep enough drop. We didn't get a big enough, push up from the broad market. What went up since April? What really went up since April? Very few sectors. Primarily semiconductors. That's it. It wasn't something that went everywhere. It was pretty much only semiconductors and some banks and maybe some real estate investment trusts. But for the most part, not everything went up like crazy like last April 2025. So failing to get up above about the 500 level is a sign that a rebound does not have enough energy to achieve escape velocity, and it invites the market to go back and at least retest the last price low. We have not gotten that outcome this time, at least not yet. And the RASI is still below 500, now making a divergent lower high at 366 for the moment, which disagrees with the higher highs by the Dow Jones Industrial Average and the New York Stock Exchange Composite Index. And it is not just the AD RASI giving us this signal. We have a nearly identical message from the New York Stock Exchange Volume RASI, in which the 500 level carries the same message. The New York Stock Exchange Volume RASI also is showing a current divergence versus the New York Stock Exchange Composite Index. Okay, well, so this ratio adjusted summation index, RASI, is calculated the same way as the classic summation index my parents created In 1969, with one adjustment, we divide the AD by the sum, so advanced minus decliners, by the sum of advanced plus decliners to get a ratio. And then multiply the result by 1,000 to get something more like a real number. It is equivalent of pretending that there is always exactly 1,000 stocks trading every day. Doing this makes for a better long-term comparison, factoring out the changes in the number of shares issued. So the number of stocks always fluctuates. This is not the S&P 500, which is about 500 stocks. This is not the NASDAQ 100, which is about 100 stocks. Even the S&P 500 and NASDAQ 100 are not exactly 100 or 500 stocks. Did you know that? Yeah, look it up. Sometimes they have 502 stocks. Sometimes they have 101 stocks. So anyhow, to keep everything equal for comparison purposes, he does this trick. The plus 500 number. It is just something that we have found over the years is useful to watch. And it is not like plus 501 is great, but plus 499 is bad. It does not work that way. Seeing a failure around the 500 level is a bad sign. Getting up well above 500 is a sign of strength. And yes, there can be some squishy in-between numbers that are hard to interpret. Welcome to stock market analysis. So, yeah, you know, these things are just fuzzy, right? This is fuzzy. This is not exactly a exact science right now that we're doing here. We also see a similar sign from looking at the AD summation index for the stocks that make up the NASDAQ 100. I have taken to calling it the NASDAQ 101 index because they just added space X without dropping a component. So for now, there are 101 companies and 103 stocks because they count both share classes of Google and Honeywell. So Google has two classes, right? A class C and a class A. That's why there's a GOOG ticker and a GOOGL. One allows you to vote in the shareholders meeting, one doesn't. Old school boomer stocks used to do this a lot. If you remember Viacom used to have a big class C share, which was a different price than the class A shares. So if you wanted to vote at the shareholder meetings, they wanted you to pay more per share to block you. You know, back then it was a big issue to have expensive stocks to kind of like gatekeep people from voting in a shareholders meeting. That was the old school way that they did to block people from voting, but that doesn't work anymore. Okay, there you are. You got that. We got some 50 failures right here. So maybe we're about to crash and burn. That's what this is saying. Because the number of stocks usually remain fixed at 100, we do not have to do the adjustment for changing numbers of issues over time. So the plus 50 level for this summation index works like the plus 500 for the RASI. And the interpretation is the same. That failing at or below 50 is a sign of trouble for liquidity, and thus eventually for prices. In the case of the NASDAQ 100, its summation plus 50 failure has at least brought a sideways period for price movements. The fascination with the Mag 7 has worn off, and now everybody is worrying about semiconductor stocks. There is always a story behind any episode of liquidity starting to dry up. The bigger mystery now is why the New York Stock Exchange related averages are not faltering. One could look at the Fed, which for unknown reasons is still doing about $30 billion per month of QE5, even though the new chairman, Warsh, does not like a big Federal Reserve balance sheet. That is adding liquidity to the system and perhaps papering over some of the problems which would otherwise be occurring. Or perhaps the market is just waiting for bearish summer seasonality to get ripe to perform its fulfillment of the RASI plus 500 failures. So, yeah, we have yen, we have earnings, we have China, we have AI, blah, 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 blah. What is going on, right? And we have Iran. So we have a lot of stories we could tell. We don't know which of these stories would matter. Or all of these stories would matter. I don't know. So that's what we're going to be watching out for, okay? Blah, 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 blah. What else? What do I want to talk about? Talk a little bit about gold, right? Gold and Bitcoin a bit. I think I mentioned some of the cycles, but I'll talk about that later tonight. I don't think we need to discuss that right this moment. We're about 2 hours, so we can be done with that. The market is about to close. So I can stop sharing this and put back the screen. Let's see what's going on with the markets right now. I think the Nasdaq still puking, right? I don't think this is are still at where we're left off. Nvidia is still down. Okay. Let's see. Let's look at the QQQ. Yeah, it hasn't improved much since the last we saw it. It still looks like a nasty red candle to me. Okay, how about the S&P? I think this looks a little bit better, but not really, because it went up and went back down. So we're staying at this 737 area, which once broke. I think we will revisit the 720. Okay, that's where we're gonna be for the SPY ETF. There we are, having fun, good times. All right, let's look at some gold. So GDX, how is GDX doing? Okay, so it's been trying to make a bottom here. Looks like we've been trying to make a bottom. Let me erase a few things. This is all messy now. Let me get rid of these things. So we got this. So we passed through this. We kind of got close to the 67 on the GDX. That's where you would have bought something, but still, we haven't really made much improvement. Okay, but I'm definitely looking at gold. Gold is about to approach its bottom. The bottom is going to happen sometime August through October. So in these 3 months, you will start seeing a bottom form for gold. Will gold hit 3,000? I don't know. It could in those 3 months still. But if you're looking to buy some gold miners, you're probably going to get interested as we get through the earnings season, right? You're going to look for these earnings season results. You're going to say, okay, we already had one gold miner report earnings. Newmont reported earnings, so didn't really change anything. We're still stuck here. So Newmont is still stuck around $90. We didn't get anything. Well, now we're gonna have to wait for gold to do its thing, right? And what else we have? We have Bitcoin. So Bitcoin, Ethereum, both of them will have options expiration at the end of this week. Look at that. It's trying to hold up. It looks like it's about to be bullish. You can see the indicator here. It's kissing it right on the MACD. All you need is one candle or two candles or three candles to push this daily DI line up. And then once the trend resumes, then the ADX will go up. That's what you're looking for. How about MSTR? What is MSTR doing? The proxy of Bitcoin. There we are. Let's see. Yeah, this at least is holding a shelf here. It looks like it's still moving up. Okay, dokie. Come on. All you need is some good DI, green DI to push this up. All right. Okay, so we got what else you guys mentioned here? The BMNR Ethereum ETF from Tom Lee. All right. Let's see. Yeah, that's doing a lot better than MSTR, right? This actually looks like a bullish chart right now. All you need to do is not do this. You don't want it to crash through this line, right? If we drew two parallel lines, it's looking like this. We're about to break out. This looks great. DI, the green DI is up. All you need is to push this up, and then you are ready to go. Ready to go. How about the weekly? The weekly still needs a lot of work, right? I'm sure it does. But as long as this MACD start moving away from the signal line, and then this green DI starts moving up, then we're ready to rock. So there we are. So if you believe in crypto and you don't feel like waiting into December, because I said the bottom could take as long as it can up through December. This might not be the true bottom, for all these guys. You might have to wait sideways. It's just going to go sideways now. But if the semiconductor stocks start crashing, it's just like the software stocks. people are selling semiconductors, they want to go somewhere else. They ran to software. After they're done loading up on software, they might start loading up on gold, silver, and Bitcoin again, because a lot of gold, silver, and Bitcoin, a lot of the money started being taken away from those areas at the same time the semiconductors went up. So you could hypothesize that people took away money from gold, silver, and crypto to chase Micron, SanDisk, Intel, AMD, Nvidia, right? That's the assumption you're making, which is plausible. It's plausible. I can't prove it though, but it's plausible because the same amount of money that went into semiconductors appears to have left the crypto and silver and gold trade. Okay, the paper trade. I'm not talking about physical gold and silver. Physical gold and silver are fine. The Chinese are buying up gold like crazy still. But the paper markets, it looks like ass right now. And the paper markets are full of retail traders that just chase the next shiny thing. Okay, that's it. That's all I wanted to say about that. What else? Let's look at the Microsoft. Microsoft. We already mentioned Microsoft. Microsoft will be the big software earnings. We're going to have to see how this goes. You can see like it's at the bottom of the range. This thing had better get back up here after earnings, or else the IGV is going to crash and burn, and they'll take everybody else out with it. So software looks like it could be a good play, but it might not be. All right. So pay attention to Microsoft earnings Wednesday after the close. So outside of semiconductors, that's what you got to be looking at. All right. I'll see you guys probably tonight in a few hours, like maybe 4 hours. So 4 hours, I'll try to be back. Wrap it up with talk about AI from the Chinese AI stuff and more Japanese yen talk. Some cycles. Gonna look at some cycles. Look at some DeMark. That's what I'll be looking at for you guys. Okay, but overall, the boomer portfolio has worked well. That's exactly what I wanted to see. That's the type of stuff that will start off the Substack at the beginning. That's what I'll be focused on. And we'll move from there. Okay, later.